There are financial statement implications to the cost flow assumption that a business chooses. Now, let's be clear. This is a choice that an organization makes about which cost flow assumption to use, whether you use specific identification, FIFO, LIFO, or weighted average. It is a choice. Now, it would make sense if the business chose something that matched reality, like a grocery store most often would sell the oldest things, so you would think that the grocery store would use FIFO. Or let's say a landscaping company, if they are selling rocks out of a big pile, that would probably, the cost flow assumption that would most likely match reality is LIFO, because they just put the new rocks on top of the old ones. And then when someone comes in to buy a bucket full of rocks, they take it off the top of the pile. So something like that would match reality, but businesses don't have to pick the one that matches reality. Again, these are just assumptions, so they can do the accounting how they want. And this has real world consequences on the financial statements, specifically the income statement, the cost of goods sold on the income statement, and the inventory on the balance sheet. All right, so let's go back to our scenario of we're selling a can of soup for $3. And let's say the grocery store uses FIFO, or first in, first out, to track their cost of goods sold. So we sell a can of soup for $3. The one that we sold was the oldest one, which is this one over here, the $1 can of soup. So in that case, we'd say we made $2 of gross profit. So we sold it for $3, and we subtract the $1 cost of goods sold, and so our gross profit is $2. Where if they were using LIFO, they would say, well, we sold this can of soup over here. We only made 50 cents. So the cost of goods sold is much higher, and the gross profit is much lower under LIFO. Now, this, generally speaking, in times of rising prices, which is most of the time, FIFO will give the lowest cost of goods sold and the highest net income. LIFO will give the highest cost of goods sold and the lowest net income, because the prices are much higher, so therefore more expenses means lower net income. Now, knowing this, when and why would a business choose to do FIFO over LIFO? Imagine that a business is trying to impress some investors, and so they want to show that they are making money. So you would presumably choose the cost flow assumption that would give you the highest net income. Or in this case, that would be FIFO, because hey, we made $2 off this can of soup instead of 50 cents. So we'd say if we're trying to impress investors, we'd want the one that gives us the highest net income, which usually is FIFO. All right. And you might be wondering, why would I want to show low net income? When would I want to use LIFO? And in what instance would I want to do that? Well, guess what? There is a situation where I want to show the lowest net income possible, and that is when I am paying taxes. So if I can show that I made little money, I will not have to pay as many taxes. So businesses that are worried about their taxes are going to choose LIFO because that gives them the lowest tax bill. And so you might be saying, hey, can I choose FIFO for my financial statements to investors and LIFO for my tax returns? Well, guess what? The IRS knows this trick. So they say you can use LIFO on your tax return. It is allowed, but only if you also use it for your financial statements. So the IRS is saying, hey, you can use LIFO. That's fine. You can use it, but you also have to use those same numbers to report to your investors. So if you're going to look bad for taxes, you're also going to look bad for your investors. So it takes away some of the incentive to do that kind of juggling between FIFO and LIFO, and doesn't allow the company to have its cake and eat it too. All right, so weighted average would be in the middle. So if FIFO gives the highest net income, LIFO gives the lowest net income, weighted average is usually going to fall between those two numbers. All right, so those are some of the motivations and consequences of choosing a cost flow assumption over another one. And just to be clear, this has nothing to do with the customer's experience. The customer has still only paid $3 for the can of soup. They don't know anything about whether the company is using FIFO, LIFO, weighted average. They don't care. It does not affect that first journal entry, what the customer has paid. It only affects what the second journal entry, what we paid for that can of soup. And so it should not change the customer's experience. It just changes how we as a business report the money that we made off of the sale.